What if I told you the smartest investors in the world are losing to something painfully boring? While millions chase expert stock picks and market predictions, a simple index fund keeps quietly crushing them year after year. So why do 90% of active fund managers eventually fail, even with teams of analysts, billion-dollar research, and non-stop trading? And more importantly, is Wall Street selling you a game you were never supposed to win? For decades, investors were told one thing: if you want real wealth, you need professionals who can beat the market. That promise created an entire industry built on stock picking, market timing, hedge funds, and expensive financial strategies. But beneath the polished suits and financial jargon, there's a brutal truth most people never hear. The market has a silent killer: fees, emotions, and human arrogance, and over time, they destroy performance. Meanwhile, index funds do something almost insulting. They simply buy the entire market, stay patient, and let compounding do the work. No drama, no predictions, no ego, just results. Wall Street loves selling the fantasy of beating the market. You see ads with confident experts staring at stock charts, talking about alpha, special opportunities, and market insight. But here's the reality check. Most active fund managers don't beat the market long term. Not some, most. Over a 10-year period, more than 90% of active managers underperform their benchmark indexes. Think about that. These are professionals with massive research teams, real-time data, and insider-level market access, and they still lose to a simple index fund. Why? Because markets are brutally efficient. The moment new information appears, millions of investors react instantly. That means consistently finding undervalued stocks becomes nearly impossible. But the bigger problem is something even worse: human emotion. Active management sounds exciting, but excitement is expensive. Every trade creates costs. Management fees, trading commissions, taxes, and emotional mistakes. And those small percentages quietly destroy compound growth. Imagine two investors. One earns 10% annually, the other earns 8% after fees. That tiny 2% difference sounds harmless. But over 30 years, it can erase hundreds of thousands of dollars. That's the terrifying power of compounding. Small leaks become financial disasters. And active managers face enormous pressure. When markets crash, fear takes over, managers panic, investors pull money out. Strategies change, bad decisions multiply, the system becomes emotional chaos. Meanwhile, index funds keep doing the same boring thing, holding the market and staying consistent, and boring wins, again and again and again. Index funds don't try to predict the future, they accept a simple truth: nobody consistently knows what happens next. So instead of chasing winning stocks, they own everything: the biggest companies, the growing industries, the future winners, automatically. When weak companies fail, they eventually get removed from the index. When strong companies dominate, they rise naturally. The system quietly adapts. That's the genius. Index investing removes the most dangerous factor in investing: human behavior. No panic selling, no revenge trading, no emotional gambling, just systematic patience. And patience is incredibly powerful, because wealth rarely comes from intensity, it comes from consistency. Here's the uncomfortable truth: active management often isn't about performance, it's about ego. People love believing they can outsmart everyone. Wall Street sells this belief perfectly: exclusive strategies, secret insights, elite managers, complex trading systems. But complexity creates stress. And stress eventually breaks systems apart. Index funds feel boring because they remove excitement. But boring is exactly why they work. No constant decision-making, no emotional exhaustion, no pressure to predict every market move, just long-term ownership of economic growth itself. And over decades, that simplicity becomes almost unbeatable. The market doesn't reward the loudest investor, it rewards discipline. While active traders fight endless battles trying to outsmart millions of people, index investors quietly let time do the heavy lifting. Because true wealth isn't built through constant action, it is built through patience, consistency, and surviving long enough for compounding to work. Sometimes the smartest financial move is accepting that boring wins. Stay tuned for more videos on money, investing, and financial psychology. And if this changed the way you see investing, subscribe to the Wealth Insure Lab channel and hit the like button. See you in the next video.